Alright, so taking a different approach this video. Going to try and teach my strategy essentially because recently I've just been posting my breakdowns, back testing, but I want to actually get into the nitty-gritty of Forex, what it's about. First of all, my backstory, uh, I'm 17. I've been training for about a year and a half now, and way I got into trading was watching a course by Swaggy C, my mentor, person I learned everything I know from, and the way he traded stuck to me. So if you do know Swaggy, you're gonna see a lot of similarity between what I'm teaching and what he taught. Not because I'm trying to copy him, but because it's what stuck with me, and that's what I learned and how I am going to teach anyone who's interested. Um, Basically a course for free. I put all the information I could out on this to try and convey it. If I do plan to make a course in the future, which I doubt, I would probably go more in depth, spend like a lot of time on each thing, and probably go and back test myself because I did include screenshots, a lot of screenshots. It's very in depth. This PowerPoint is very in depth. So we're gonna begin with chapter one, beginners. Um, Everything you're gonna learn just you don't know Forex. This is for you. So what is Forex? Forex means the foreign exchange market. It is the exchanging of currencies against each other. For example, when you go to another country, say Canada, they have a different currency than the US does. So when you're at the airport, and you have $1,000 USD, you can exchange the $1,000 USD for Canadian dollars, and you may get 900 Canadian dollars. Let's say you don't spend a dime that for a year. When you go back to the airport with the same amount of Canadian dollars to exchange for US dollars, you might get 950 US dollars or even 1,500 US dollars. This is all to say that the exchange rates of currencies fluctuate all the time. So, why do the currencies fluctuate? These currencies fluctuate due to many reasons. Supply and demand of a currency are one of the main reasons. When a currency is in high demand, meaning more people want the currency due to its low interest rates or low inflation or anything, the value of the currency will be stronger and therefore increase. Big time investors are one of the main supply and demand population, and we'll get more into this more in a bit. This isn't really too essential to learning how to trade, but it's good to get the history. So, um, by the end of this whole series, uh, I'm just this is everything I've learned. So by the end of this series, you should in theory you should know how to trade. Um, it's just putting it into your own practice and learning how to do it yourself. But for now, we're yeah, just going to take it one step at a time. But this is just the background. So to piece this all together, the way the forex market works is it pairs two currencies against each other. Example given: Euro USD, which is the Euro dollars against the US dollar, and the way they are compared are put into numbers. So let's say the price of Euro USD is 1.3259. This means 1 euro is 1.32529. I made a typo. 1.3 to 539 US dollars. It's the same. In this pair, euro would be called the base currency because it's the first currency and in the pair, and your USD would be considered the quote because it's the second. And the forex market is huge. In the forex market, around $5 trillion worth of forex exchanges or forex transactions occur daily. 5 trillion. That is a lot. More than the stock market, more than it's a lot. It's one of the highest. I'm pretty sure it is the highest. Could fact check that, but it's extremely high. And in forex. price moves based off people moving price. And it's not like us, like retail traders. It's big time investors and traders. It's forex markets and prices just made up of people trading. So we're not the only traders. The market consists of a hierarchy of traders. At the top of the list, there are super banks that trade, such as JP Morgan. Under that, large commercial companies, then central banks, then the government. Below them are us, the retail traders. The big dogs, or the people you saw on the at the high of the hierarchy, are the ones who move price a lot. Uh, we can make millions of dollars in the forex market, but it wouldn't move price because of how insignificant the money is compared to the total volume traded daily. So how we make money. In the forex market, we make money by speculating on how these exchange rates, as discussed previously, will fluctuate. To do this, you must analyze the charts. There are three different types of analyses: technical, which is chart-based analyzing; fundamental, which is world-based or news trading; and sentiment, which is your own bias towards a pair or the own bias towards price. So you see how I say, if you watch any of my previous videos, how I say, my bias is that price will do this, yada yada yada. That is my sentiment on the pair. Um, and you build a sentiment through using technical and fundamental analysis. So some terminology we will need to move forward to understand everything is you will hear all of this whenever trading, by the way. So buying slash selling. Buying price means you entered for a price to go up. Selling price means you entered for a trade for a price to go down. I meant to put trade in the first one, but long slash short, it is slang for buying and selling. Uh, Slang for buying and selling. Buying is long and short is selling. Bullish and bearish. Bullish means your sentiment is price rising, and bearish means your sentiment is price dropping. So basically, bullish is going up, bearish is going down. A pip, this is the value of how price moves. Price moves in pips. For price to move from 1.31000 to 1.32000, that is 100 pips. The last number doesn't count as a pip value. Different pairs will have uh different prices, as you'll see, because it's different currencies. But the main consensus in this with pips is that all pairs move with pips. So lot size, the lot size dictates how you make money. This is the number you will put into your broker, which will be the platform you will trade on. And it will dictate how much money you make. You multiply your lot size by the pip value to determine the amount you make. If you have a 1.00 lot size and you're aiming for 100 pips, that means every pip is worth $100, meaning you would win or lose $10,000. We'll go more into brokers and what they are later. Liquidity slash validity, volatility is volume in price. Margin is when you trade on margin, you borrow funds from your broker to be able to open larger positions based off the amount of money you have in your account. If a broker requires a 10% margin, you will need to deposit $1,000 to control a $10,000 position in the market. The broker lends you the rest of the funds. So margin is a good way to make more money than you actually have. Leverage, this is how you're able to trade with more money than you have. With 10 to 1 leverage, you control $10 for every $1 of your own money. If you have $1,000 in your account with 10 to 1 leverage, you could open a position worth $10,000. Leverage and margin are closely related, but these examples should exemplify the difference. Spread is the difference between bid, the bid and ask price of a currency. The bid is the price at which a buyer is willing to buy the currency, and the ask is the price at which a seller is willing to sell the currency. This is extremely important as the spread will dictate how much money you are set to lose when entering a trade. When you enter a trade, you will always be negative a few cents, or if spread is high, a few dollars, and it will mess up your entry. I highly advise you do not enter when spread is high. Spread will be high either due to news or the beginning of market open, which explain market open later. Spread is the ask price minus the bid price, but you don't need to know that. You just your broker will likely you'll know how to tell spread based off the charts. Um, Very important. Take profit, which is which basically says that when price reaches this exact point, I want to get out of the trade with the profit that I have made. And stop loss is the exact opposite, saying that when price reaches this point, I'm losing this amount of money, I want to get out of this trade. Your broker will take you out of the trade. Entry and exit. Entry is the process of looking to enter a trade, and exiting is exiting a trade. More on lot sizes. The Forex market is traded in units, and the amount of units dictate the lot size. A micro lot is 1,000 units, which is a 0.01 lot size. A mini lot is 10,000 units, which is a point zero 0.01 a point 0.1 lot size, and a standard lot is 100,000 units, which is a 1.0 lot size. Some brokers will have you. I'm pretty sure on MT4 you have to put in the units, but it's good to know the units and the correlation to the lot size so you could be versatile in case it doesn't let you put in the lot size. The higher the lot size, the higher the amount of money you will be down when entering a trade, as the formula to determine this the, the formula to determine this amount is spread times lot size. The three types of analysis, as said before, technical analysis is simply reading the chart and trading off of that, looking at historical price movements and determining the movement of price. Fundamental analysis is news-based trading, economics, uh, politics, policies, etc. These affect price heavily, but um, it's not advised to trade purely news-based. Sentiment analysis is each trader's own bias towards a pair, basically what they think price will do. Currency pairs. There are two types of currency pairs: minor pairs and major pairs. And commodities. Major pairs would be pairs that have a lot of trading volume. They tend to move slower and are more structured. Some major pairs are Euro USD, USD JPY, GBP USD, USD CAD, AUD USD. Minor pairs are pairs that are more exotic and not recommended for beginners due to their high volatility. Some minor pairs are GBP AUD, Euro JPY, AUD JPY, CAD JPY. Commodities are metals such as gold, oil, and silver, which are expressed on the charts as XAU USD, oil, and XAG USD. Sessions. The Forex market is 24/5, which means open 24 hours for 5 days. Even though it's 24 hours, people aren't working 24 hours in their respective country. The city with the major financial hub in the relative time zone is given the session title during their business hours. When it's 8 a.m. to 5 p.m. in New York session, it is not, I mean, in New York, is not 8 a.m. to 5 p.m. in London and Tokyo. So whenever normal business hours ensue in the actual countries, their session is active. The main sessions are New York, London, and Asian. The market closes on Friday at 5 p.m. and opens Sunday at 5 p.m. Asian session begins a few hours after the market resets, which is every day when the market is open at 5. Um, Between 7 to 8 p.m. is when Asian starts. Tokyo is the major financial capital of Asia. About 21% of all Forex transactions are done there. Um, Japan is the world's third largest Forex trading center as well. Yen is the third most traded currency as well. Liquidity may be thin. Most activity occurs in the beginning of the session when economic news is released. A lot of news from Australia, New Zealand, Japan, and others are announced. London session is right after the Asian session, starting around 2 to 3 a.m. Eastern time and lasting until 12 p.m. I don't think I said it when Asian ends. It ends at around, I think when London starts is when it ends. I think so. So London is looked as the capital of Forex. Over 32% of all Forex transactions are carried out there. And when it's the London session, it has a lot of liquidity, very high. And it slows down in the middle of lunch. Oh, it slows down in the middle, which is lunchtime, basically. Trends may reverse towards the end of the session as traders are looking to lock in their profits. Towards the second half of London session, New York's session starts, which causes an overlap. This overlap could lead to a lot of volatility, by the way. The New York session starts around 8 a.m. Eastern and ends at market reset at 5 p.m. Eastern. 85% of trades involve the US dollar. Very high liquidity during the overlapping period with London session. Most times, economic news involving the dollar are reported in the morning. There are a few times where news can be reported later in the day, second most volatile session, and London is the most volatile, by the way. The sessions you trade is based on your schedule and availability. If you aren't available to trade the New York session, as you may be busy at work or school, then find a pair to trade that has high volatility during your session. When pairs aren't trading in their session, it will be it will likely be giving away to enter, confluences, retracements, or consolidate until the pair goes into its session and starts trending. For me, uh, sessions aren't that important to me because most of the pairs I trade move at any time of the day. So I don't tend to pay attention to sessions heavily, but some people do. So you need to know your trading style and what you're really trying to accomplish and your pairs and see how they move. And just know that because you might not be available during the whole day. So one session may be good for you. Pairs to trade during sessions. During Asian sessions, these pairs are most likely to have more volatility. Gold, which is XAU USD, GBP US AUD, USD JPY, AUD USD, New Zealand USD, AUD JPY. Try to stick with pairs that have AUD New Zealand and JPY in it. In the London session, GBP USD, Euro USD, GBP AUD, Euro JP, GBP, GBP, Gold, GBP, JPY. During the London session, try to stick with pairs that have GBP and or Euro in it. New York session, Euro USD, USD CAD, Gold, GBP, USD, USD JPY, and try to stick with pairs that have USD in it. Market reset. At 5 p.m., Eastern every day, the market resets, which means the trading day is over and liquidity is reset. Immediately after the market reset, spread increases a lot. Do not enter right after market reset. It is the end of the trading day as it is the all end of the trading sessions. It's one thing I notice is around 6 p.m. is when spread tends to minimize itself. So types of traders. There are three types of traders. Swing traders are traders looking for long-term gain. They get in on Monday, get out by Friday. Swing traders typically hold their trades between a few days to a few weeks. They're looking for massive pip gains. They also usually have larger account sizes. Intraday traders are looking to trade daily, get in a trade at 8 p.m. and get out by 8 a.m. Get in at 3 a.m., get out by noon. Majority of traders in the world are intraday traders, and scalpers are traders who are looking to get in and out the market fast. They use high lot sizes with high leverage repeatedly. They usually stick to volatile pairs and are glued to their screens, trading on low time frames. So it's important to know which trader you want to be. If you're looking to just get in and out the market fast, then scalping might maybe for you, but you need to understand what you want out of trading. Differences between stocks and forex. Um, one of the one difference is the trading volume traded daily. The stock market has around 200 billion dollars traded daily, with the forex having $5 trillion traded daily. With the forex market, you can buy one pair and sell another, while stocks have restrictions on only selling stocks, um, only allowing buying. Forex has minimal to no commissions, while stocks have commission. Forex is a 24-hour market, and stocks are an 8-hour market. Forex has a range of 70 currency pairs to trade, and stocks have over 3,200 companies that could be traded. So depending on your trading style, if you're looking for a more short-term or medium-term growth, Forex would be great for you. If you're looking for a longer-term growth, the stock market would be better, uh, as it doesn't have much volatility. Oops. Okay. And that is the end of this chapter. The next chapter is technical analysis. Uh,